Guys, most people think that millionaires are made by finding some next great hot stock like Nvidia before it skyrockets, the one that really grabs all the attention. But let me tell you something that will surprise you. They're all wrong. Some of the biggest fortunes in history of the stock market were built by owning boring, durable companies that very few people talk about when it was the best time to buy. In fact, many people would avoid them when it was the best time to buy. So in this video, I'm going to show you how it's possible for normal people to quietly become millionaires in the stock market. And it's not by chasing the trends. It's by following a simple, repeatable process that most investors ignore. And I'll even show you one stock that I think fits that process today. Now, here's the problem that most investors don't realize that they have. They don't usually lose money because they pick bad companies. They pick great companies, Nvidia, Palantir, Tesla, for example. But the reason they lose money is they buy at the wrong price and sell for the wrong reasons at the wrong time. Study after study shows the same thing. Investors tend to chase what's already gone up, buy late when the story feels safe, and sell early the moment things get uncomfortable. What's the result from that? Massive underperformance compared to the very market they're trying to beat. In fact, between 1996 and 2015, a 20-year period in which the S&P returned 8.2% per year, the average investor returned only 2.1% annually. Guys, that 2.1% fell below the performance of bonds, of gold, of oil, and even inflation. This happens because hype is seductive. And when stocks start to fall, they panic sell. And guys, everybody has been there. Everybody's been sucked in the emotion of it. We're all humans. This is not the thing you need to beat yourself up over. But boring stocks can help you do the opposite. They feel slow. They don't give you bragging rights. And most of the time, nobody cares about them, which is exactly why they're so often mispriced. We talk about this in our community all the time. The stocks with the most attention often trade at the highest prices, which means they're less likely to become a great value. That's the disconnect that most investors miss. Boring companies bought at the right prices will oftentimes beat the stocks that everyone is talking about and everyone is chasing. And I promise you, once you see this pattern, you're never going to look at boring stocks the same way again. You're going to actually go chase those boring opportunities. When people look back at great stock market success stories, they usually remember them the wrong way. They remember the end result, not how boring the journey actually was. The best investors can sit and watch paint dry, because while these companies eventually become obvious winners, they didn't feel exciting while the wealth was being created. In fact, most of them were ignored, doubted, or written off as too boring for many years. Now, I'm not going to tell you all of this and skip the part where I prove it to you. So let me show you exactly what I mean. The first example, Home Depot. Yep, the company that sells lumber, tools, lawn equipment, building materials, screws, all that bullshit. Most of you have probably been in a Home Depot many, many times. They're a retailer that tend to be tied to housing cycles, construction trends, and consumer spending. And yet, over the past 40 years, Home Depot has delivered an annual return of just over 20% per year. That means that a $10,000 investment grew to over $14 million. The business itself never changed the world. It simply executed well, it scaled efficiently, and benefited from long-term demand for home improvement. The biggest takeaway? Investors who bought it at reasonable prices and held through cycles didn't need to predict recessions or housing booms. They just needed to find a great company that executed well, and they needed patience. Number two, let's talk about one of the most overlooked compounding machines in history, NVR. They're a home builder, an industry most investors avoid like the plague because it's highly cyclical, very capital intensive, and it's heavily tied to interest rates. On top of that, NVR doesn't even own much land, which sounds boring and conservative, but that's exactly why it worked. By avoiding owning so much land, they remained capital light. So NVR still benefited from long-term housing demand and used all that freed up capital to do one of my favorite things. They bought back shares at great prices. So what's that result? Over the past 30 years, NVR has compounded at over 27% annually. 10% invested became $13 million. But guess what? The business fundamentals didn't go up that much. They just bought back shares at the right price. Okay, final example, Ross stores. Ross is another company that never looked exciting. It's an off-price retailer selling discounted apparel and home goods to middle-income consumers. No premium branding, just value, consistency, and scale. But guys, over the last 30 years, Ross has delivered an annual rate of return of about 23% per year. Your $10,000 invested in Ross would be coming right about $5 million. So before we even talk about the current stock that fits this process today, we need to set some ground rules, because this video is not about stock tips, and it definitely isn't about finding one stock that magically makes you rich. What we're doing here is teaching a process, and I want to make sure you understand 3 key factors that drove the strong long-term returns I just showed you. And that process starts with one core idea: price versus value. Price is what the market shows you every day. It moves based on headlines, emotions, and short-term noise. Value is what the business is actually worth based on the cash flow that it can generate in the future. Great businesses can be terrible investments if you pay the wrong price. Average businesses can become great investments if you buy them at the right price. The best example I have is the Blue Chip Stamp Company back in 1971 or 2. Warren Buffett and Charlie Munger bought this business, and 13 years later, they had gained a 15% annualized return on that investment. The business started when they bought it at $120 million in revenue. 13 years later, it did $100,000 in revenue. You heard that correctly. From $120 million to $100,000, yet they made 15% returns. Why? They paid the right price. If you buy a declining business at the right price, you still make a lot of money. Second factor is buying with a margin of safety. A margin of safety means that you don't need everything to go perfectly. It's the gap between price and value. So if value's here, price is here, no margin of safety. Price is here, a lot of margin of safety. Price is here, negative margin of safety. It gives you that buffer in case your future assumptions don't work. Guys, we're humans and we make mistakes, and the future is unknown. This is why you need margin of safety. And the third piece is finding boring but strong businesses. We're not looking for the next big thing. We're looking for businesses that, 1, people will still use 10 or 20 years from now, have survived cycles, and have solid fundamentals. Boring is not a flaw. It is often a feature. What I'm telling you is applying the sound process over 10 or 20, 30 businesses like this, bought at the right price and held patiently, the odds will tilt heavily in your favor. The stock I mentioned earlier in this video that may fit this criteria is Southwest Airlines. Now, guys, I own the stock. Don't buy it because I own it. I'm here to teach a process. Even though I like the stock, there's always issues with a company that I might be overseeing or underestimating. I'm here to teach the process of how to think about Southwest. Now, here's what I like about Southwest. They run a simple, boring airline that's focused mostly on domestic US flights. Even though I'm not a fan of the airline industry, I do think Southwest is the outlier in this industry. They fly one aircraft type, the Boeing 737, and that keeps their operations straightforward. They avoid complex international routes. That helps them. And with that same boring plane, they're able to really fine-tune their inventory of parts and their mechanics. That simplicity has helped Southwest remain profitable for 47 consecutive years before the COVID shutdown of the entire travel industry. Not only 47 years of profit, 47 years straight of profit in the airline industry. And guys, what Southwest does very well is they properly hedge their gas. So when gas prices are low, they're probably paying more than they should. But if gas prices are very volatile and skyrocket, they pay less than they should. Now today, the market treats Southwest as if something is permanently broken. But what we're really looking at is a margin recovery story. Demand has largely returned. In fact, they have higher revenue than they did before COVID. And now we're watching for profitability to normalize. There is no excitement around this stock. It has gone nowhere since COVID, and that's exactly why it's interesting to me. This is what's similar to what we've seen already with NVR, Home Depot, and Ross stores. Boring businesses can often become great opportunities if the stock is selling well below its intrinsic value. And that's what I'm going to show you how to identify that disconnect right now. So let's pull up Southwest in our software. Look at this. Here's the 10-year chart. It's only up 9% over the last 10 years, not per year, total. So that's like 0.8% a year, annualized. It has gone nowhere for 10 years. In that 10 years, though, what has happened to the financials? Let's take a look. They did $19.8 billion in 2015. This last 12 months, they did $27.55 billion. The business has gotten 50% better in terms of revenue. Let's go look at profit's a little bit different also because they did $2 billion. And this is the issue I have with Southwest I'm excited about. Look at everything before COVID. 2.2, 2.2, 3.3, 2.5, 2.3. These were consistently 10 to 15% profit margin. Then look at the profit. Loss of $3 billion, not even $1 billion, $500 million, 470, and $380 million in the last 12 months. Now, guys, if this seems overwhelming, it's okay. It's been overwhelming for me and everybody else in the world when they started. The question I have for you is, do you want to do what you did in your other job and your other activities, is start feeling overwhelmed, but then work through it and become better at it? It's worth the time. So stick with us here. We're here to simplify all of this. Guys, think of every company like yourself. If you knew that you were making a ton of money back here and then COVID hit and it decreased your income significantly, but you were working to build it back, but there were still some things you were paying or issues you were working through, but you knew this was possible again, how confident would you feel? That's what I'm feeling about Southwest. I don't see why it would be different this time that they make continuously less money. This is their profit. 10-year profit margin, 4.8%. That includes 5 years at 1.4 and 1 year at 1.4. But guys, they've been dealing with computer issues. They've been dealing with credits to consumers because they had some issues. I don't think that's the permanent status for Southwest Airline. Now, guys, there's a lot of key metrics here I want you to understand. They're very important to understand, but here's the key. You're not going to understand it unless it's sitting in front of you and you're listening to it and using it every day. So I made a cheat sheet for you. Click the link below, download this key metrics PDF. It's going to send you all of these metrics in one easy PDF that you can read, understand, and know why they're important. That way, when you're watching videos, you can pause them when you don't understand a metric. And even better, and what friends of mine love to do is, they love to sit there and use these metrics to sound smart in the room. It's fun. But of course, this is why I'm teaching on YouTube, because they don't teach this stuff in business school. They teach you boring things like efficient market theory and all these other things. Now, in a couple of minutes, guys, I will go over what the right price to pay for Southwest is based on my assumptions. But let's go check out their 8 pillars. It's probably going to be pretty ugly. Oh, not as bad as I thought. 4 X's. We have no cash flow over the last 5 years. We have no cash flow last year. Earnings are garbage. But again, earnings are based on a very low profit margin based on history. Return on capital sucks because it includes the COVID time. Of course it sucks. But they bought back a lot of shares, guys. They've bought back 13% of their shares in the last 5 years. So this is a company who believes, they're like, hey, listen, we're tight on cash, but our stock is dirt cheap. And by the way, in the last 3 months, it's up 38%. And even with that, the 10-year is still only up 9.3% overall. This stock has gone nowhere in 10 years. That in and of itself does not mean it's a buy. It's all in relation to what else we see from it. So let's go see what analysts think about the company. Well, guys, they estimate $2.70 per share in profit this year, growing to $6.50 in the next 3 years. Guys, if you want to assign a PE of 20 to this, it makes the stock a $130 stock in 3 years. But don't believe it just because analysts say it. I do think there's a lot of potential there. And look at this boring company growing its revenue 7, 5, 5.5, and 7.5% per year. I don't know. This looks pretty interesting to me if you ask me. So now, we have a little bit of a story. We have a little bit of numbers. Before you do any more research on it, make sure the numbers even jive where it's worth your time. So I'm going to go to our stock analyzer tool here, and I'm going to input my assumption in the future. Let me pull up the last time I did it, and let's go over my assumptions. Guys, I did a 10-year analysis. I did 3, 5, and 7% revenue growth. Next line, what is your profit margin and free cash flow? Guys, remember, they did consistently 10 to 15% in the years leading up to COVID. I put in 8, 11, and 14, not even maxing out at their best years. Next, what PE would I assign to Southwest 10 years from now? Well, it's a great business in a tough industry. So I'm still putting 14, 17, and 20 because I always tell people start at 15 or 16, go up for good businesses, down for bad businesses. To be honest with you, I think it deserves a premium. I think it should be 16, 19, and 20, and 22. Why? Because it's a well-run airline. And look at the 10-year returns on capital. It's 7.3%. After the last 5 years have been 0.6% negative. So their returns on capital were double digits. In fact, they were 14 or 15% leading up to this. This could justify a much higher PE. And then finally, what's my desired return? Guys, I'm putting 9% in here just to get my intrinsic value. It's not the price I want to pay for it. Again, we need margin of safety. But you're going to see in a few seconds why I'm so interested in this company. But remember, don't do anything without doing more research on it. Hope is not a plan. I used to buy stocks hoping that they would go up. But hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. All right, guys, so I hit the analyze button. Here's why I'm interested in this company. I have a low price of 60, high price of 180, middle price of 110. To me, if I could have 20 or 30 companies with these kind of potential returns, I am going to do quite well. Doesn't mean Southwest is going to do great. But the whole point is if I buy 20 or 30 companies with these kind of metrics, I'm going to do quite well. Guys, the bigger lesson here that you need to take away is that wealth is built by owning a collection of durable businesses bought at the right price. And you need to be able to hold them patiently over time through the good news and the bad news. It's the repetition of the process, not the brilliance of one pick, that does the heavy lifting. If you can do this across 20 or 30 companies and consistently demand an ample margin of safety, you will dramatically increase your odds of beating the market and building long-term wealth. Now, guys, if you want one more example of this to really show the value in boring businesses, look no further than Warren Buffett, the Oracle of Omaha. He started buying Coca-Cola shares back in the late 1980s, and it wasn't some exciting growth story. Coke was already a mature business with a product that existed for almost 100 years, might have been over 100 years. They invested roughly $1 billion. That initial investment has since turned into around $27 billion without Berkshire needing to trade in and out. In fact, today, they receive over $800 million per year in dividends from Coca-Cola alone. So 35 years later, they're getting their entire investment back every single year in dividend. Now, he doesn't just own Coca-Cola. He owns Bank of America, which he's decreased his ownership of, Costco, Chevron, American Express, just to name a few. He owns a massive portfolio of durable businesses at good prices, and that's the one reason he has done so well. So as we wrap this up, let me be very clear about the title of this video. No single boring stock is going to magically make you a millionaire, unless you get lucky, but don't bank on luck. The stock market only rewards excitement in the short term. When you look at decades, it doesn't reward the headlines. And it sure as heck doesn't reward chasing what everyone is talking about. As Charlie Munger would say, it rewards people who understand what they're buying, refuse to overpay, and have the patience to let good businesses compound over time. That's how normal people quietly build wealth. So if you want to see more companies that fit my process, guys, I did something awesome last year. I'm really excited about this. I picked 7 boring stocks that at the time I owned all of them that I believe can beat the Magnificent Seven over a multi-year period. And I'm going to be honest, this year's results were not what I expected. So you're going to want to see who made the list. So you can click on the video right here to check it out. Thank you for your time.